again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us for our market insights and observations. Today is August 1st of 2023. Yes, we made it to August. Let's talk about the three topics we're going to pay attention to as markets are, as you should be too. Thanks for watching. So right out of the gate, we're going to talk about the moderating hawk. By that we mean on the Federal Reserve Board. We'll talk about who specifically said something this Sunday on one of the talk shows that has impact on moving markets and future interest rates. As well as the S&P is up now. We've had some great sort of year-to-date performance by all the markets, specifically S&P as well. And then this is a big earnings week, so markets could be interpreting what's going to happen next and looking for signs as to how inflation is working through corporate balance sheets. But let's get right to it right now. Well, Neel Kashkari, who is on the Federal Reserve as a voting member, was on Face the Nation this last weekend, and he highlighted that the core inflation is still running double of what the Fed's target of 2% is. So core inflation is around the 4% number. And he said, even though inflation rates are moderating, we do not want to declare victory just yet. Okay, so it's important because if you remember in the late 70s, early 80s, that was the issue of the Federal Reserve. They basically said, hey, listen, inflation's taken care of. We've got ahead of it. We've won. And as soon as they did that, they lowered the interest rate, and inflation sort of did a head fake on them and took off even higher. And so they have to go higher for longer if you want to use that playbook. Back in the Volcker days of the early 80s, how to break the back of inflation, which means you have to do damage to the economy, and i.e. the consumer, and then the consumer spends less, and ultimately that's less in corporate balance sheets. And the shareholders, i.e. stockholders, potentially we have to navigate the ways through that, because there are going to be winners and losers as we see more turbulence on the economy, because the intake valve, or the oxygen tank, if you will, which we call the money, the U.S. economy, the money supply, is dwindling and then slowly but surely being sucked out of the room, and we'll show you how. But as of right now, what's important about Neel Kashkari is he has always been a hawkish member of the Fed. So he has always been in the camp of raise, keep raising interest rates. So for him to moderate his conversation means that what the Federal Reserve Chairman said, which was true, or is coming in line with more or less, that they're going to be data dependent. Now, as I said before, what does this all mean? Well, the cumulative effects of interest rates are having a negative impact in terms of what the consumer is dealing with. And you and I don't have to, basically spend more than 2 minutes on this. If you look at the new car sort of loan, it just hit a new record at 7.2%. So you have to go out there. If you get a new car, it's 0% financing. Good luck if you can find that. You're going to look at 7% with great credit. That's unheard of. It's an all-time high. So that's going to negatively impact, right? Those dollars that you have to allocate for a car, if you need one, are going to go in this direction versus this direction. So again, corporate balance sheets are going to be sort of stretched looking for that dollar. Even used car loans now at the 11% level. It's incredible. And so this is going to have a knock-on effect. If you add all that together, in the new mortgages are $2,850 on average. That just means that an American who wants a new car or a new house and is paying $3,600 a month or $43,000 a year after a 20% down payment, that's 62% of the median household income of the United States. So that means it's not going to be very affordable or realistic right now for, again, about 60% of the consuming public. This is also another important chart that we want to point out is in morning research. This will probably play into more and more, but basically this is the real inputs of goods and services, and inputs normally don't decline unless there is a recession. Now, Neel Kashkari just said, because the Fed doesn't see a recession on the horizon, but the imports here, if we look at this is trending lower, okay? So meaning we're consuming less as consumers. That's natural because everything costs more. We're going to consume less. Every time this has happened in history, this trend, we've seen it go below. We have seen these gray bars right here, and I'll just highlight them here. The gray bars are coinciding with a recession. So we will see where this ends up later on. So we're going to constantly keep an eye on that, pay attention to that. And it's not just the sort of U.S. consumer, right? 2/3 of the U.S. GDP is made up by you and I consuming. Don't forget, the federal government has trillions of dollars in debt, right? And they have to pay on that debt by way of interest rates. Well, look at what they've done to themselves. This interest rate, so current government expenditures, i.e. interest payments, there's only so much that they can basically get in taxes. There's only so much revenue that the government can actually use to basically allocate. Something's going to give over time, the cumulative effect of this. If interest rates continue to rise as the debt rises, and the basically net carrying cost of all this is going to rise. It's going to go into entitlements. It's going to have to cut the budgets of entitlements, maybe defense, maybe Medicare, maybe something, because those are large pieces of the pie for how we allocate our tax dollars. This is going to be, if it stays there persistently, is going to be a problem in the future. So we believe at some point in time, interest rates will have to come back down. It could take some time, but maybe 2024, maybe 2025, no one really knows. But interest rates are going to have to relieve pressure, and QE, quantitative easing, the Fed's going to have to go into that again and start buying bonds, basically to continue fueling this. Maybe that's what the market ultimately is seeing through all of this into the future. Now, this is a very interesting chart that we pulled up, and ultimately what you're seeing are three different charts together, okay? The first part is the S&P 500. The bottom part is the inverted yield curve. So inverted yield curve here, 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 and now here. We're at the most inverted we've seen for the longest period of time, historically speaking. What does that actually mean? Why are we seeing that? Ultimately, and this is in the middle, this is the unemployment rate right here. So unemployment rate, every time we've had a purple bar, and a purple bar ultimately is a recession of some sort, then we have an increase in the unemployment rate. Now, the unemployment rate, right, at 3.6%, economy's humming. Even Kashkari earlier said he can go to 4% on the unemployment rate, meaning people have to lose their jobs. Something economic has to happen for the Federal Reserve to sort of slow down on this course. And if you've seen that, every time markets have sold off as a result. We don't know here, so this one's the question mark. But historically, if you look at the patterns that are building, the pressures that are building, the signals that are being basically, coming across our research, yeah, there's something, we've had a great year to date, but we're positioned. We have a lot of cash, a lot of treasuries, a lot of high quality equities for our clients. If we see the markets pull back, there are some aspects to the market that we'd like to get into, but we're waiting and we're being patient. So this wouldn't surprise us if we had sort of September, October, November pullback. Seasonally, we see that. Now, the last chart I'm going to talk about is S&P 500 is up. Now what? Where are we going from here? Well, we don't know again, but historically, again, this is the balance, the diversification, the cash on hand, the ability to strategic rebalance and markets pull back and grab something that's down 5, 10, 15, 20% as we've done so in the past for our clients. And we intend to do so moving forward. But the S&P, here's a great chart that we have. Now, this shows that the S&P 500 going back all the way back to 1949, all of these data sets, and ultimately is looking at the S&P 500, and specifically when it's had 5 straight months in a row, 5 consecutive months in a row, up. So we've just seen that with the S&P 500. What does that mean for the next 3 months, 6 months, 9 months, 12 months, 18, 24 months, okay? And the most consistent data of surprising data here is, in the short term, in the next 3 months, we could see some turbulence. Historically speaking, it's sort of a mixed bag. So that wouldn't shock us if we've had 5 months in a row and some give back, okay? At least historically, going back to 1949, that's what we've seen from the S&P 500. We've also seen it get a little bit better as the noise continues, let's say the next 6 months. But here's what's interesting. We only have one down year, and that is in 2018, when we've had this sort of data sequence of reoccurrence. 9 months after the S&P 500 has had 5 consecutive months going back to 1949, there's only one time where the S&P has been negative. And the average is up 9.8%. That's a win rate of 97% of all of that data set. Now, could this be that one outlier year where markets still stay down 9 months after this particular period of time? Again, we don't know. But again, that's why you have to stay in the game, because at the very beginning of the year, no one would have said, hey, NASDAQ's up 30%, S&P is up 10-15%, and all of the respective indices are up year to date. In fact, all of Wall Street was asking and sort of positioning for a negative year to date. So that's why you have to look at the historical aspects of what the markets have given us in the past and sort of make educated guesses and common sense and just balance and diversify as we do for our clients. That's all we have for today. Thank you for watching. And if, again, you want to review, you want to talk about something, we're always here for you. At the same time, don't forget to like and subscribe and share with friends and family. We appreciate it. Take care.